In this week's video, we'll review the latest charts, data, and model scores to help us answer the question, is the secular bull market dead? We'll be moving quickly, so feel free to use the pause button on your video player. Let's see where we are relative to the support levels that we've been talking about for several weeks. Slide from the August 18th video, where we noted that in terms of the strongest band of support in here, wouldn't be shocking if the S&P 500 fell approximately 8 to 10%. It's the version of the chart that we covered in last week's video where we noted 4 key areas of possible support. If we look at the exact same chart on Friday, October 20th, have we given up this important band in here? The answer is no. This is the closing level on Friday, October 20th. This band here is the same band here, here, and here that we showed back on August 18th. You had a weak close on Friday, came right down into that area. Thus, in the short run, it's noteworthy. This isn't particularly confidence-inspiring up here. What once acted as support may now act as resistance. Probably fair to say that this cluster of VWAPs here has been relevant in recent weeks. Thus, with the weak close on Friday, it's prudent to head into next week making no assumptions about what's going to happen between this point here and this point here. This is an area of possible support. Similar situation as of the close on Friday, October 20th with the broad S&P 1500. The intersection of what we believe to be the two most important VWAPs, the 2022 high and the 2022 low, are approximately 1% below Friday's close. This orange line here is this line down here at the October 2022 low, and this dark blue line here is the dark blue line here, anchored volume weighted average price line, tied to the January 2022 high. See, previously price broke above that blue line, oscillated above and below it for a while, and then moved in this direction. So these aren't binary regions of possible support. Could be a lot of gray area in there, but like all support levels or possible support levels, the longer we're below these levels, if we drop below them, the more relevant it becomes. Similar situation if we look at the weekly chart for SPY. The purple anchored volume weighted average price line from the 2022 high comes in here, and the pink volume weighted average price line from the October 2022 low comes in basically the exact same level. That's approximately 3% below where SPY closed on Friday, October 20th. Thus, in this general region, calls for some patience above and below these levels. Same can be said in here, but if we move out here, probability of taking action starts to increase. The same is true here, and even more so if price moves into this region here. Thus, if we take emotions out of the equation, stock market really hasn't done anything thus far that's particularly surprising relative to what we talked about back on October 18th. That may change very, very soon, but it hasn't changed yet. If you follow the Fed closely, it's probably fair to say they're either finished with this rate cycle or they've got maybe one more hike. And if that's the case, 5 out of the past 6 rate cycles, a recession did not follow within a year of the last hike. Got an oversold market near areas of possible support. We have to keep in mind it's possible we could get a relief rally. Oversold near support, good combination. Doesn't predict anything, just speaks to probabilities. And as we noted on Twitter earlier this week, the S&P 500 is near several logical reference points. Gap down here from August of last year. 41.95 is the bottom of this gap here. Same basic area, acted as resistance in February of this year. Acted as resistance temporarily here. And then we had the gap up in June of this year, right around 42.32. During Friday's session, 200-day moving average in red at 42.33, right near key area B, with the strongest and most important band of potential support still below price. Not making any assumptions, trading the chart in front of us. We'll see how it plays out. It's a DeMark chart of the S&P 500 futures. It's noteworthy. This gap here, when we came down the first time earlier in October, we held at the top of this gap. If we came back into the gap, it aligns with this area here of potential support right around 4,200. During Friday's session, we're about 50 points, 45 points above this level. If there's a mini panic into the close, good to keep in mind. NASDAQ Composite during Friday's session, similar situation. We could have significant additional weakness from here to here. All of this has occurred above an upward sloping 200-day moving average in red. We're still above this gap here from late May, early June of this year, and above the down gap here from August of last year. Area of possible support, area of possible support. 200-day upward sloping could act as possible support. All of that still below price, so we could see some additional weakness before this, or this is tested. Weekly NASDAQ during Friday's session, got some oversold readings here. And the loss in momentum thus far, MACD, still above the zero line, telling us right now this is a counter trend move within the context of an existing uptrend. All of this over the past several weeks occurring above an upward sloping 200-week moving average. And thus far, we're holding this area here that acted as resistance in August of last year. From a longer-term perspective, it's very difficult to say that any significant damage has been done yet to the longer-term trend weekly chart with the 200-week moving average in red. Covered this numerous times. Typically, when you see a momentum turn like this with the monthly Kopic curve historically, really good things have happened. If you know your market history, 1982, 1984, 1988, 91, 2003, and 2009 are bullish entry points. Doesn't predict anything. Speaks to the probability of good things happening longer term relative to the probability of bad things happening longer term. Place this in the anecdotal evidence category. We covered this last week. This is sentiment as of October 5th thus far. It had been holding the uptrend near the October low from 2022. How does the exact same chart look this week with a new reading? Still holding that line, and you can see when we broke down in a similar manner over here, that was the beginning of the end in Q4 of 2021, and after that, bad things happened. Let's shift to the economy and interest rates. It's a major understatement to say that this is a massive and rapid move in interest rates. It's a chart of the 10-year yield. You can see this area acted as resistance in 1966, support in 1968, support in 1971, support in 93, support in 1996, temporary support in 1998, resistance in 01, 02, 06, and 07. We're not quite there yet, but it's possible somewhere between 5 and 5.5%, let's call it 5.25%, that this area could act as resistance for rates, at least temporarily. Similar situation with TLT, nearing an area of possible support, very long-term support. This is 2002 here. This is 2007 here. This is the price of TLT unadjusted. Bottom panel is adjusted for stock splits, dividends, and distributions. Similar situation. Resistance, resistance, support, 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 support. We are near that level in the present day. So we have TLT near an area of long-term potential support. Interest rates approaching a band of long-term potential resistance. S&P futures near an area of possible support. S&P 1500 near a band of possible support. S&P 500 near logical areas of possible support. Doesn't predict anything, but the case for remaining patient is still intact. It's difficult to make the argument that the rapid rise in interest rates doesn't speak to a strong economy. Pull the data off Fred during Friday's session, all of it still looks constructive. And as we've covered many times, the first recession domino that typically falls is people start to lose their jobs, which is what happened during this COVID fear spike here. Unemployment claims, lower right-hand corner of your screen. We just don't have any evidence backing up that first domino is falling or is even about to fall. If we look at credit spreads up close, they have moved a little bit, but you can see there's nothing significant here relative to past spikes in fear. This data was updated this week. Have we seen a big spike? Are credit conditions as tight as they were in 1974, 1980, and during the recessionary period in 2008? The chart in front of us says no. Economic data from the Federal Reserve Bank of St. Louis, trend in inflation unquestionably favorable. PCE data here, CPI here, the trend unquestionably favorable. Core PPI has been coming down. As the rapid rise in interest rates caused a lot of stress in the financial system, is something about to break? Not according to these three measures from the St. Louis Fed, the Kansas City Fed, and the Chicago Fed. Look how the red line crosses the zero line right here in 2020 during the COVID fear spike. Look at the exact same line today. At the moment, this really doesn't look anything like this. Not a lot of change here, as we've noted. Trend in average hourly earnings, which speaks to inflation pressures and wage pressures. Favorable since early 2022. The tight labor market that we've been talking about has been softening somewhat for quite some time, and the labor force participation rate has been moving in the Fed's favor. At this point, it might be helpful to ask and answer. Do rapidly rising interest rates and a much stronger than expected economy align with or contradict the favorable demographics that we have today? And more importantly, what those trends will look like and what the numbers will look like over the next 5 to 12 years. Don't really have any evidence in hand today to contradict any of this. And in this June 23rd video, we talked about the possible implications of a secular shift in interest rates from down to up. And thus, what we've been seeing in recent weeks is not particularly surprising, maybe with the exception of how rapidly we've moved from point A to point B. And while this is concerning, history tells us that long-term interest rates can rise significantly from 1950 here, and they're not necessarily a showstopper for a secular bull market that began here in 1950. Let's check in on the VIX. The S&P 500's close on October 3rd and the close on October 20th basically identical, a few points apart. On October 3rd, we were 7.83% off of the recent closing high, very, very similar level as of Friday's close. Find the details of this study by Googling this title here and our last name, Shavako. The VIX was red a good part of the session on Friday, closed fractionally green, and then ticked up even more between 4 and 4:15. But it's fair to say a level of 21 and change is still significantly lower than 31 and change. Concerns would increase if we move into the mid-20s next week, and that absolutely positively may happen. We have to keep an open mind about that. The intermediate term trend, unequivocally down. The bulls have proven next to nothing in recent weeks. But thus far, a VIX that's still hovering around 20-ish isn't particularly alarming. We can always come up with a very long list of concerns relative to the economy and the stock market. October 2023, no exception. Numerous things to be concerned about. But the biggest risk may be another major Fed mistake sometime in the next 12 months. We saw similar headlines, except they were telling the markets that they weren't going to raise interest rates for a very long period of time. And as we all know, that was not the case. In this segment, we're going to review the market's long-term trend in the context of the topics that we covered back on September 1st. This is the headline from September 1st. So let's see if the present-day charts align with or contradict this headline and see where we stand relative to these bullet points. Primary trend is up. Tolerating swings will most likely add value versus overtrading. Bias in the next 6 months should be up and possibly volatile. Well, over the first 2 months, we've got the volatility piece down, and we really won't know about the bias over 6 months until the end of February next year. It's a long way off. On September 1st, we said inflation, interest rates, and history say big swings are possible within the primary trend. And we'll also take a look at some secular trend scores to see what we can learn. In 1953, we're still in a secular trend that began in 1950, and the strongest part of that trend lasts until the end of 1968. The secular bull market doesn't make its final high until late 1972, early 1973. And as we've covered in the past, if we can successfully navigate between a point A and a point B that could be several years down the road in the context of a secular trend, the rewards can be extremely satisfying. The S&P 500 moved 429% from this low in 1953 to this high here in early 1973. But unfortunately, to capture a game-changing gain like this, you had to deal with a lot of volatility between point A and point B, which is why we've been saying for several weeks, secular does not mean easy. So if this is our goal, it's very difficult to see how we're going to accomplish that without allowing our account to swing, and sometimes allowing our account to swing significantly. If you own the S&P 500 index and you held it from point A to point B, here's your gain. In the real world, that's a lot easier said than done. And capturing a gain like this seems great. But if we look at all of the drawdowns from this low in 1953 to this high here in 1973, the table shows every drawdown greater than 6%. To navigate from point A to point B, the average drawdown was 16%. The median drawdown almost 14%. And as we just discussed, we're down approximately 8% from the recent high. So it's very difficult to look at something like this and say an 8% drawdown means the secular trend is over. Why is it so difficult in the real world to capture a gain like this? It's very easy to answer, especially if we remove the volatility between point A and point B. If our account balances went up every day and we received nothing but positive feedback between point A and point B, it'd be a cakewalk to capture the 429% gain. It's not the way it works in the real world. We have to deal with the markets as they are, not as we wish them to be. How do we stand at the moment relative to the health of the secular trend? Remember, we said that this secular bull went from 1950, and the strongest piece of it went to the end of 1968, the window shown on your screen. And for the most part, the S&P 500 made a stand at or near an upward sloping 200-week moving average. Very similar situation in the secular bull market that lasted from this low in 1982 until the peak in March of 2000. The S&P 500 made a stand at or near an upward sloping 200-week moving average. This week, it's difficult to look at this chart and say that the secular trend is over or even in jeopardy at this point. If we look in the rearview mirror, 2016, 2018, 2020, Q4 of 2022, like this window here and like this window here, the S&P 500 made a stand at or near an upward sloping 200-week moving average in blue. And we're still above that same upward sloping 200-week moving average on October 19th. This is as of Thursday's close. And even using this small chart here, it's very easy to see that the market is approaching a strong band of potential support. And all of this has occurred above an upward sloping 200-week and an upward sloping 200-day. So relative to the secular trend, the secular bull market's moment of truth really doesn't come into play until 39.36. There's a lot more information about these concepts in this short takes post here. You can find it by Googling the title on your screen and our last name, Shavako. Within the context of our objectives, trying to navigate between a point A and a point B that could be several years down the road, how can the secular trend volatility model potentially help us? Regardless of how things play out relative to the current secular bull market, volatility and givebacks are part of the equation. They're a necessary evil. This decline here brings new capital into the market, allowing it to eventually post a higher high. Thus, our goal in this environment is to try to differentiate between these periods marked by very strong trends within the context of the longer-term secular trend. These are the periods where, for the most part, we want to try to leave our portfolios alone between this point A and this point B. That's true here, 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 and here. And sometimes the move from A to B can last several years. But given some of these drawdowns are extremely painful, we want to develop a tool that helps us discern between the blue box and the orange box. And maybe more importantly, what does the tipping point look like in here? This tipping point, this tipping point, this tipping point, this tipping point, and this tipping point. And this one's extremely important because the drawdown between point B and point C, almost 50% in the 1973-74 bear market. This is not part of the secular trend. Thus, multiple objectives. How do we discern between the blue boxes and the orange boxes? And how do we discern between the orange boxes and this red box and this orange and red box that's somewhere in between? There are numerous ways to do that, one being Bollinger Bands. Secular trend 1982 to 2000. When the trend is healthy and strong, price tends to stay above the upper Bollinger Band. When we get near that band, these are yellow flags. When we can't hold the band, it's a red flag. This is the peaking process here. The S&P 500 loses approximately 50% between this point A and this point B, loses approximately 50% from this point A to this point B. How does the exact same chart look this week? October 19th, still holding above the upper Bollinger Band. And even if price came down to the center line at 38.77, really wouldn't be out of character. That happens sometimes within the context of a secular trend. And you'll notice in this case, we do not hold the center line, and we do not hold the center line here. Conceptually, this helps us with all of this. There's nothing magical about it. That's why you're using a weight of the evidence approach. The model examines 114 charts and asks 485 binary questions using different tools, different indicators on different time frames, and frankly with different objectives. The portion of the model that we're going to be talking about today relates to the tipping points that we talked about earlier. How do we discern between leave it alone and we may want to take some action within the context of a secular trend? Thus, the secular trend volatility model helps us discern between periods of strength and periods where our portfolios are more susceptible to a significant drawdown. We could almost name this model the secular trend susceptibility score or the secular trend vulnerability score. The higher the score, the less vulnerable you are. The lower the score, the more susceptible you are to a significant drawdown. Nothing magical about it. This is one way to do it. This is another way, and another way within the context of a weight of the evidence model. You can see in this portion here of the current secular trend, in this window here from 2013 to this peak here in 2015, the trend is strong enough to stay above the moving average envelope for the most part the entire time. It's true in this window and true in this window. If we can't hold it, it's basically telling us that the present day isn't as strong as this window or this window. And we're starting to become more susceptible to something like this. Ichimoku clouds are used in the model as well. This is the monthly cloud as of Thursday's close. There's nothing particularly alarming here yet. We do see signs of weakness on the weekly cloud, but we're still checking, for the most part, bullish boxes. We covered this chart a few weeks ago, as of Thursday's close, above all of the moving averages. Another example here using a monthly chart with closing prices. Relative to the 3 secular trend periods, haven't seen anything yet that's particularly alarming. Holding all of these, holding this, and holding this. We can see the secular trend window here in 2012 to the present day looks discernibly different from this window in here during the dot-com bust and the financial crisis. So let's take a look at some of the results to see what we can learn about helping us navigate between point A and point B and potentially mitigate some of the damage in these cases here within the context of the secular trend and ultimately avoid or significantly mitigate a 50% type drawdown. Realize this is difficult to read, but I'll walk you through it. Remember, we've got 114 charts. We're asking 485 binary questions, and those questions are weighted to help us with these tipping points. How do I discern between this point here and these points in here? So model scores range from 0% to 100%. 100% means strong. You look a lot like this. 0% would mean you look very weak. Thus, as you might imagine, your tipping points logically are going to come somewhere around when the market is near 50%. So on August 19th, 1957, the reading in the model was down to 53%, and it was helpful because the additional drawdown after that reading was almost 17%. Fast forward to August 19th, 1957, your 0 to 100 score is down to 36%, still helpful because the additional drawdown was still double digits at 13.2. In this case, model at 54%, 46%, and 27%. The additional drawdowns, 21%, 21%, 16.5%. Similar situation here. We've got a very strong trend that starts to deteriorate. Our scores go from 65 to 48 to 32 to 30, with the additional drawdowns being 18%, 17%, 14%, 13.7%. Then we get back to a stronger period in here and we start to deteriorate again. We're at 63%. The market rallies. We go back to 76. Then we drop to 60 to 43 to 30 to 11. We get a rally. We're back up to 24. And when it's at 24, we still have an additional drawdown of almost 28%. How about the 49% drawdown in the 1973-74 bear market? Relatively early in that bear market, your score drops to 55%. After that point, the additional drawdown 43%. Almost 2 months later, here in May of 1974, you're down to 31%. Additional drawdown 41%. If we put all of these scores in a table and differentiate them this way, the drawdown in 1957 into this drawdown in 1966. These drawdowns occur in the stronger portion of the secular trend. Remember, we said the strongest portion is from 1950, the end of 1968. And you can see when your scores, your average and median score that we just talked about in that window, let's call it 43% to 46%. The additional drawdown, average roughly 17, median roughly 17, and that occurs over the following 95 calendar days, median 74 calendar days. Similar scores out here during the weaker portion of the trend, and the drawdowns after that substantially larger, 32%, roughly 30%, Thus, the magnitude of the drawdown is larger here, and the duration is significantly longer. Let's call it 75 to 100 calendar days here. This is more like a year, 350 and 379 calendar days. Thus, the million-dollar question is, if approximately 50 is your tipping point, how close are we to one of those tipping points? Said another way, how did the scores look a week ago on Friday, October 13th, yesterday, Thursday, October 19th, and during the session on Friday, October 20th, the day this video is being recorded? How close are we to this alarming territory here? And where do we stand relative to this range between 0 and 100? The higher the score, the more we look like the leave it alone periods. And the lower the score, the more concerned or susceptible we become to a larger drawdown. Remember, it's a vulnerability score. It doesn't predict anything. It tells you at the present time, how vulnerable are you? Score last Friday, 85%. Yesterday, 79%. During Friday's session, when the S&P was down 39 points, approximately 76%. This, and this align with the concept of trying to be patient to see what happens near this key band of support. You're not making any assumptions about what happens here, nor here. And it is noteworthy. These scores can drop rapidly sometimes. They typically don't, but it's very, very possible that you could see a score like this and in relatively short order be down into this range here. Maximum flexibility 100% of the time, not making any assumptions about what next week or the next 3 months looks like. If the data allows, we'll continue to give the base case the benefit of the doubt. We always talk about our goal is to navigate to the right side of the table. And in this context, our goal is to navigate to the right side of the chart while respecting 100% normal and to be expected volatility that can occur within the context of a secular bull market. If we need to implement a mitigation strategy, meaning we're concerned about something like this, or this, and these scores start to drop and move towards 50, we absolutely positively are ready, willing, and able to take some defensive action. Given what we've seen in recent weeks, it's prudent to keep in mind, in markets, anything can happen at any time. That includes something really good happening next week, and that includes something really bad happening next week. And while there's no question there are reasons, based on hard evidence, to remain patient, and there are areas of potential support approximately 1% to 3% below where we closed on Friday, and these scores, in the context of history, at this point are not particularly alarming, the concerns that we covered last week are all still in play, and thus from a contingency planning perspective, it's prudent to assume that the market's going to break support rather than hold support. We need to remain on guard until the market is able to prove something. We always talk about how technical analysis and analysis of markets is based on subtle shifts. In the past 2, 3, 4 weeks, the end of the week has not been good, including Friday's session. So as we head into the weekend, and as we update our contingency plans this weekend, we'll be keeping in mind that the bears control the daily tape. Credit spreads, they're tame, but they can move very, very quickly. The scores we just covered, they look pretty good, but they can drop rapidly. The VIX, not really at an alarming level, but it can come to life at any time, and all support is possible support. And trading the chart in front of you and trading the data set in front of you applies both ways. It applies when we're holding support, and it applies if we break support. And it's incredibly important in this environment, with the 10-year yield rising rapidly in recent months, that we don't get stuck on a story. We don't let our ego get in the way. if we update and or develop bearish if-then plans. And what do we mean by this? If the market does this, then we're going to do this. If we develop these plans and we don't use them, no problem at all. Always prudent to be prepared in advance. And as we all know, the only way we can do all of this effectively is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.